Welcome to the Cashflow Academy podcast. I'm your host, Andy Tanner. This is where we make investing fun, simple, and real. I'm joined by my dear friends, Noah Davidson and Corey Halliday. Guys, thanks for coming.
Excited to be here.
Well,
Great.
that was weird.
Jinx.
Yeah.
Great topic coming up. Earnings season coming out. A lot of tech earnings coming out. And there's some systemic risk out there. So we're going to talk about how investors approach earnings. I'll be interesting to see what you guys have to say about it. I know I've got some opinions all throughout for sure. But first, make sure you like and subscribe to the channel for sure. Hit your notification bell so you know when new information's been released. And most importantly, go to yourinvestingclass.com. Let me say that again. Go to yourinvestingclass.com. And we got free stuff there. In fact, go there now because what we have there, we have a ebook. More than a class right now. You can download that ebook, and I can tell you this: when you read it, you will see a before and after, how you thought about it before and how you thought about it after, and you will be quantum leap closer to your goals. You really will. You'll see 6 numbers that will absolutely change your life. Go to yourinvestingclass.com and get your free stuff because it's there waiting for you. And with that, let's talk a little bit. Well, let's introduce ourselves briefly. Let's start with Noah this time.
I don't have a clever introduction for myself this time. Oh, no. What am I going to do?
That's okay. You're a non-clever.
Well, there you go. Hi, I'm Noah Davidson. I have been trading and investing for the last 25 some odd years now. And I have had the opportunity to teach tens of thousands of people how to trade and invest with more confidence, giving them a game plan. So
nice.
That's my background.
Well said. Well said. Corey.
Yeah, I think we all started around the same time, so about 75 years collectively, or over 75 years of experience in the markets. And my experience initially, out of college, I got licensed, Series 7 license, eventually worked my way up the ladder and became a Series 4 option principal, which is the head of option trading for the firm. Did that for many years, worked for a New York-based firm. We had an office on Broad Street. So if you're familiar, there's Wall Street and Broad Street. And I operated out of the options division. A lot has changed in the options division, which has made it so much better for individual investors. Costs have come down. Now you can trade with zero commissions. Liquidity's gone up. Quantity of trades. There's never been a better time. And since we're going to talk about systemic risk, you need to know about options.
For sure. Speaking of systemic risk, we should define that a little bit, define the jargon. So there was a story, some people might not remember it, but I remember it. There was a British oil company, and they had some oil rigs in the Gulf of Mexico.
Yeah.
And they were called British Petroleum, and their symbol was BP. Well, British Petroleum became known as Broken Pipe pretty quickly, and they had this awful, just a complete ecological, I guess you'd say, environmental, just a.
Yeah, and the news would
show. I almost said it was a shit show. I don't know if I'm allowed to say that on our thing.
Well, it was.
It was an oil show anyway.
And the news would show. Remember the footage, and they would just show the oil spewing off on the ground.
That's where Dawn dishwashing liquid started washing ducks on TV, showing how they could make them yellow and fluffy again. And they were washing ducks and wildlife.
Yeah.
It was a mess. Well, their stock, when that pipe broke, was $60 a share, and it halved it. It went to 30. And so that's called a non-systemic risk, because Microsoft is still fine, and IBM is still fine, and the others are still fine, but that particular company it didn't affect the entire system, since the term non-systemic risk. Well, if you had all your money in BP, all your eggs in one basket, you lose half your money. But if you only had 1% of your money in BP and you had 99 other stocks, you only lost 0.5% of your money. So people say, see, you should diversify.
Yeah.
However, later on, we had a subprime meltdown where the whole system was cut in half. We went from 1,500 to like 666, the devil number, whatever. Yeah. We went from 1,500 and got cut in half. all the diversity in the world not only couldn't help you, it actually goes against you. So when someone puts you in a diversified portfolio, you could say to your advisor, I thank you for the diversification. I see that you're trying to manage some non-systemic risk, but when I see the Fed and when I see the fiscal irresponsibility, and I see bond illiquidity, and I see derivatives of a quadrillion, and I see off-balance sheet commitments of hundreds of trillions, what are you doing to address the systemic risk
Right.
that is present? So,
and you look at the differences between those. We have companies that we own that go through earnings or go through these events, and those are specific to the company, right? Because if I own shares of IBM and IBM's reporting earnings, that stock might go up or down 5% on the earnings result, but the market's not really going to move on that news. The market moves, the systemic, that where it impacts everything, are things that are deemed to be impactful for the global world or economy. If it's going to hit GDP or if it's going to be better, AI might be a systemic benefit, right? Whereas tariffs and all of these concerns might hit GDP and growth and trade. And so that might be a systemic problem for the market as a whole. So we look at those two individually as saying, okay, this is company risk. This is a unique risk to this one business, or is this something that impacts the market as a whole? And then we have gauges that will show us whether it's a systemic risk or not. Like the VIX is a good example of a representation of systemic risk.
yeah,
The VIX is not going to move because one company reports earnings.
right.
The VIX is going to move because it deems it to be a systemic problem. And that's why the VIX recently spiked up to 60 on all the tariff stuff, is because they deemed it to be a systemic problem or something that could impact every company or the vast majority of them at least.
Or you can add a little leverage behind that potential systemic breakdown where you have the derivatives and then you have the counterparty risk behind the derivatives. And so that's kind of what the subprime meltdown was, is it wasn't just that they had some bad loans out there on the books. It was that behind the bad loans on the books, there was a leveraged derivative banking on that, and then there was a buyer and the seller on the end of the derivative, and then there was a counterparty risk, and it was 3 levels deep where we thought we were covered, but if Bear Stearns goes down, well that was who insured our counterparty risk.
Yeah.
And so it became kind of like a dominoes, knocking a bigger domino, and that can take down the system. So no, that's another way to think about the levers behind that. There's some leverage behind it.
Yeah, and to your point, if you take that subprime meltdown, the biggest problem was that the credit rating agencies, Moody's, S&P, what they did is they said, well, the housing market has never done this before, so it probably never will in the future, which isn't always a great
That's
rule
almost
of thumb.
never a good
Right.
rule of thumb.
And so then they said, well, all of these loans are bad, but we've never seen a situation where all of them go bad. So we'll package all these crappy loans together and we'll rate them
CDOs.
AAA because they're all, if one fails, well, they've got other.
Diversified.
They're diversified. So they diversified a big pile of junk and then slapped it with a AAA rating. Well, the issue there is, to your point, when you have something rated AAA, you can leverage it more than if you have something with higher risk, right? It's like at a brokerage account. Your broker will give you more margin on something that's less risky. Yeah. And they'll give you less margin if something is more risky, because they'll understand, okay, well, this has a higher level of risk. We won't give you as much potential leverage. And these financial institutions were taking these AAA rated things and leveraging up on them. And then we had massive problems when it all went sour. So the question now is, well, where is the market vulnerable, and what have they leveraged up right now that could be at risk?
So I think it's an exciting time because, I've never felt as confident about predicting where things are going to go as I am today, which is weird because it seems like it's one of the more unpredictable environments. But I feel, and that might be a red flag, to myself to kind of back off and say, hey, Andy, don't feel like you can, crystal ball this. This feels different than 1990s, but the same in that we're in a moment of tremendous technology change.
Yeah.
The internet really changed business. If you think about how we buy things through Amazon now, you can't get anything in a store.
I'm old enough to remember when people say, you're going to buy things on the internet? Are you crazy?
Yeah.
That's nuts.
They'll have your credit card. I'm not putting my credit card number out on there, and all this crazy stuff. But now retail just gets smashed by online.
Yeah.
Cyber Monday is bigger than Black Friday, I think. It's a bigger deal. Well, now you have AI, and that will allow every company systemically. AI to me is not a technology play. It is a systemic play, because the guy that makes sandwiches will make them better, buy better, order stuff better. The guy that pumps oil will pump it better. It just brings so much efficiency in production.
Yeah.
But we have this potential over the next decade that if a person isn't buying stocks, they're nuts. But in the short term, we're overvalued as we are now. We're very over leveraged as we are now. We have a lot of fiscal and monetary policies that are scary. So I think in the short term, we see this beautiful, wonderful fear and volatility and tariffs and political problems and this gorgeous opportunity for things to drop in a big way.
Yeah.
It's almost like the perfect thing. Like, as traders, we tend to be pessimists and optimists at the same time.
Yeah.
And I just think that if a person doesn't get their share of production right now, they will look back 10 years from now in the same way that you wish you would have bought. You wish you would have gone in at $85 a share on Google's IPO.
Yeah.
That really hits me hard personally, because at that moment in time, I had like $10,000 cash. I'm like, I'm going to put this into Google, but I also needed a new kitchen.
Oh man!
And anyway, the kitchen turned out really nice, and I didn't buy the Google
rather
IPO.
than the 20
in
houses.
The Google could have bought
10
about
houses.
1,000 kitchens at this point.
But it is interesting, the AI boom. So there's a lot of systemic risk right now. Earnings is that a topic we want to do a separate cast, or do we want to hit earnings right here? Why don't we talk about earnings when we come back from break? Are we good for a break? Let's ask the producer. Thumbs up on a break. Let's take a break for a commercial break. When we come back, we'll talk about the dynamic of earnings season, particularly in some technology sector, how that may or may not have some impact on the system. So we'll be back in a moment.
Really, I think anybody can follow Andy's steps to learn this. He made everything so easy. You can actually ask real-time questions with them and get real-time answers. There's so many different trading platforms. They will take the time and be able to show you how to use whichever platform you're on.
I've just really enjoyed how they have taken what could be complex material and really made it simple to understand. Learned how to take some of the complex trading strategies and produce cash flow. They really go beyond just trading stocks. They really make it about lifestyle to make yourself the best person you can be. Everybody that's an expert started out as a novice. You got to start somewhere.
Welcome back to the Cashflow Academy podcast. I'm the host, Andy Tanner. This is where we make investing fun, simple, and real. I'm joined by my good friends, Corey Halliday, Noah Davidson. We've been talking about the systemic risks. Tariffs haven't been a thing I've dealt with before or had to have. The VIX spike because of tariff stuff. Well, now we have earnings coming out. And the reason that earnings, I have my cash flow Jack in the Box here. We'll have to do the wide shot to get it. But cash flow Jack in the Box has three parts to it. It has the handle, right? And so you have the work that's done. You have the earnings, nice little money that comes out here. We've got our resident engineer that builds the cash flow Jack in the Box, Noah Davidson. This is one of the best Christmas presents I ever got. And then we have the price. Well, in isolation, the price doesn't really tell me hardly anything, and that's that's really taking your eye off the ball on CNBC, because if we were to turn on CNBC right now, they'd be talking about stock prices.
Yes.
Winners, losers, gainers, fallers.
Wall Street knows the price of everything,
Price,
and the
price,
value
price.
of nothing,
Yeah.
right?
Yeah, exactly.
Yeah.
Price, price, price. The best risk management I could recommend is to look at this handle, because the longevity of the company is really based on the quality of work and demand for that work. And if you start there, that's what Warren Buffett calls the moat, really, is, when he says get a moat, people say, well, I understand a moat is a defense of the castle. But what that really means is the value of that work so valuable that it just, like Burlington Northern Santa Fe, rail is about 40 to 50% of the nation's freight. So if you want food on the table, or lumber for the real estate, or plastic for whatever, or grains, it's going to go through rail. And Burlington Northern is the largest railroad. It would take, he estimates, about $500 billion to build that from scratch today. No one's going to take down Burlington Northern. They've just got so big and so powerful that it's just what it is. So to cross that moat and replace that work is kind of the deal. So when it comes to earnings, I think we have it backwards. Is the way some traders will do it is they'll try to guess an unknown, and they'll say, I think earnings are going to go up, and that'll make the price go up. So I'll buy this price low, and hopefully the earnings come out and the price will go up high. I think it's the opposite. I think by putting tremendous focus on the price and investing based on price movement rather than based on quality of work and increase in earnings, I would rather see an increase in the quality of work they do and an increase in the earnings they get, and let the price take care of itself. Any thoughts on that?
Well, I agree 100%. I mean, the quality of the business is ultimately what's going to determine your success long term, right? So usually a focus on price is more of a trader mindset, because they're going to be in and out in a relatively short period of time, and the fundamentals might not change that much. But as investors, we want great businesses, great quality businesses that are going to be around. Warren Buffett calls it durable competitive advantage. What is durable? Well, it's long-term, it's lasting, right? Competitive advantage. They have a competition against those they operate against. And so if we're investing in a business, we want to think through that durable competitive advantage. Is this company going to be around long-term? Do they have some competitive advantage? Can we see that business is in a sweet spot, a good growth opportunity? And then if it is a great business, well, then we can have enough, I would say, temperament to wait for the right prices.
Yes.
So we can define what price we're willing to pay, what PE ratios and things like that. But we need to build a watch list of these durable competitive advantage companies and then look for opportunities. And usually that's where the systemic risks, when those strike, that's the best time to then go and buy those great companies that you couldn't buy before because they were just too darn expensive, but they go on sale, right? And so in the COVID crash, it doesn't need to be that complicated, because if I think about where I spend my time and where I spend my money, I've bought more Apple products year over year over year for decades, right? So buy Apple when it became a huge discount in the COVID crash. I've spent more time going to Google to search. I've bought more things off of Amazon year after year. So a lot of times when we think about, well, where are the best places to hunt, think about yourself and where you see yourself spending time and where you see yourself spending money. That's a good starting point for building a watch list. And then go see, okay, is this a fad or is this a durable competitive advantage?
Earnings is going to reveal a lot about whether prices are justified. So right now we have a Shiller index that's very, very high, in the 30s, which says we're paying a lot historically relative to history.
Yeah.
We're paying a lot of price. We're paying about $30 in price to get this $1 of earnings out of here. That's quite a bit. 30, 32, 31 is where it's been at. So two things can happen. If earnings come out and grow, well, that PE will look better.
Yeah.
We'll be getting more earnings for the price we pay. If earnings fail, then that's going to go further north on us, which means there's less value in the market. But systemically speaking, I'm really curious because, I mean, you're an earnings watcher, and we could talk about the trades later on, like volatility crushes we've been doing, and we did one. What was the context? Was it the Quick Start Labs we did? FedEx?
Yeah. And we did the volatility crush.
Worked
Meta, perfectly. Yeah.
Meta is a nice. So there are trades around earnings where we don't predict the price as well as we can. We can't predict the direction of the price because we can't predict the earnings, but we can very much predict the direction of the volatility, which is going to be down.
Well, I can make a prediction like this. If Apple beats earnings but lowers guidance, and the stock price drops, I can predict that people will probably buy that dip. That's about as good as my prediction gets. It's kind of an if-then stimulus response, or if they beat earnings and raise guidance, the stock price gaps up, there'll be some profit taking, and maybe it takes off and runs, but it usually comes back down. So I can predict, or not predict is never the right word, anticipate behavioral patterns in response to the stimulus that they get off of an earnings announcement. And that's one of those things that I really like watching the earnings for, is a good company with a moat that just has a little bad earnings report and it creates an opportunity to buy something on a dip.
Tell me about this. The stock market is a barometer. You have public companies, you have non-public companies, which we'd call maybe Main Street instead of Wall Street. But even in Wall Street, within Wall Street, you have some behemoths that can do really, really well and kind of cover companies that don't do really, really well.
Yeah.
So when you see earnings season collectively, not as individual stocks, but collectively, is that, in your opinion, how much guidance and barometer do we have there? What does the compass say in terms of recession?
Well,
are we in the recession and then it happens the earnings, or then earnings start drop to say, okay, we could be going?
I think it's the recession causes the earnings to drop.
So we don't see it.
But it's also that the stock market's a leading indicator, not a lagging.
That's my question.
And so stocks typically will have already toppled over well before you start to see the numbers.
When you say that, are you talking about stock prices or earnings?
I'm talking stock prices.
Okay.
So stock prices lead, and the general idea is that it's a discounting mechanism that reacts, call it 6 months-ish before the major change. So for example, throughout history, before a stock market has bottomed, let's say, usually the stock market will bottom first, and then you'll see why it happened thereafter. There's like that's why it was happening. Now I can see that the earnings bottomed here and are starting to recover after the fact. And so a lot of times stocks are better in terms of that leading indicator. They give you some insight. And that's because as you start to think about kind of the transpiring of economics and so forth, like take this tariff example. Stocks sold off on the tariff. Now, that's not guaranteed to cause earnings to drop, but companies will not, they don't know what the future is going to hold for tariffs. So what are they going to do? They're going to make sure that they make adjustments to their business, even if it's more expensive. They say, well, we don't know where China tariffs are going to land. Are they going to stay super high? Are they going to be negotiated down? There's just too much unknown. Let's go somewhere where we know a little bit more about it and where they're likely to be. Even if it costs us more money, it gives us a better, stable viewpoint. And so all of these companies right now that operate internationally are having these discussions of, okay, what do we need to do?
Yeah.
And so stocks already start to see that in a way. They start to reflect that, where it's always been amazing to me that you'll see why it happened to a certain extent after the fact. Like, why is this stock going to new high? I remember a time where a person came on CNBC, this is probably 10, 15 years ago, and they were just they were so adamant and screaming that Amazon doesn't make any money. This is so stupid. People are paying this huge PE ratio. And I remember this vividly. And they were same with Tesla, and they're screaming into the thing. And you'd kind of listen and you'd say, well, yeah, they're not showing a lot of profits, but their revenues are exploding. So what are they doing?
Yes.
What they're doing is
they're
building for the future.
They're taking those revenues
and reinvesting.
Yes.
And so they're acquiring more and more customers. So the stock market was way smarter than this individual, right?
It's a growth stock.
Yeah, the stock market was way smarter because Amazon rather deserved to be going higher like it did. All the people that have screamed for decades about how overvalued Tesla is, well, Tesla has grown and grown and expanded out into other sectors. The stock market has been smarter. Now, it's not always the case, right? Usually when you get herd mentality to where you'll hit an extreme, bubbles will form.
Stocks.
Yeah.
I kind of think of it, and I 100% agree with what you're saying. I also think of it as like an early warning sign. Like, look how smart Warren Buffett looks right now.
Yeah.
Like, he's parked a bunch of money in cash ahead of the major market correction.
Yeah.
Why? Because he probably saw some things that raised some alarm bells. He goes, you know what? I see some troubled waters ahead. I'm going to park some money in cash. And the market responds, in anticipation of, but they're already seeing the recessionary signs. Like they're already seeing some reason for concern. And so they're trying to get ahead of that. It's a forward-looking instrument. And so by the time the market's corrected, it's already kind of reared its head.
Yeah.
And it's technically not a recession until you lose your job. I mean, 2 consecutive quarters in a row.
Right.
That's one way to measure it. But you can
well, and to that point, the Fed, if we bring the Fed into the argument, the stock market is so much smarter than the Fed. The Fed is always reactive.
Yes.
Never proactive.
Yes.
The stock market's proactive.
Yes.
Because the stock market is made up of intelligent individuals that are betting on the future, in essence. Like, what are future earnings going to be? How is this going to grow? And the collective wisdom of the stock market tends to get out ahead of these things. That's why it tops before you ever actually go into the recession. And then before the recession is done, the market's already bottomed and come out of it. Whereas the Fed will constantly be data dependent and they'll always be behind.
They're wait and see.
They'll always be behind. And the one time that they weren't even data dependent was when inflation was skyrocketing. They're like, it'll come back down.
Transitory.
It'll be fine.
It's
proactive, it's reactive, and it's overreactive because you get a proactive aspect of it. We call it the smart money.
Oh, that's great. Yeah.
And then you get there's a reactive market, and then there's an overreactive market, and the smart money is usually ahead of all of those people anyway.
Love that.
So,
That's a great way to think of it because that's what the point that I was trying to make is that the stock market's not always brilliant because it does overreact, right? It will have bubbles. And it will have crisis, and it will have things where
overreacted on the tariffs.
Yeah, you'll have price dislocations in the stock market where it's way overreactive.
A lot of that overreactive is uncertainty that caused that overreaction.
Yeah.
When we see earnings come out, let's say we see great earnings. What does it mean? Let's say we see poor earnings. What does it mean? Let's say we come out and we're surprised and we see, wow, earnings just really surprised us. What does that tell you?
To me, one earnings report means almost nothing personally. I take that as, that's one number. But I always try to have the insight of what is more of the trend.
Like I'm talking heat map.
Oh, heat map.
If you let's say I bring up
so you got
heat map.
4 or 5 big fish reporting this week.
Yeah.
You got the Apples, the Amazons, the Microsofts. They're all reporting.
So I'm talking collectively.
Gotcha.
I think that collectively, this is if I were a gambling man, I'm betting that they beat earnings.
Wait, stop there. If that's a hypothetical.
I'm betting that
Christmas.
There's enough uncertainty that they're going to lower the bar for themselves on guidance. Because it always feels good when
everyone's doing that.
So that's what they're going to be doing. So
everyone's accurately doing that, by the way.
Yeah.
I would expect lower guidance from everybody.
Lowering guidance and even also removing guidance is a common
even
theme.
More.
Because
it's so much easier to clear the high jump if you just take the bar off.
Yeah. And they have a perfect reason right now because they'll say with tariff, all this stuff, we don't know. And so we're just going to remove guidance for now. And that's
So if you see a green heat map, everyone's beating earnings. What does that tell you?
Well, generally it tells us that in the rearview mirror things have been
Better than we
solid,
thought.
better
We had a
than
great
expected.
quarter.
To me, it tells me there's a lot of money still in the system.
Yeah.
That's what it would tell me, that there's a
Yeah.
lot of money in the system. Now, let's move it back to a micro picture and we'll close out the podcast. So one of the stocks that I did really well with coming out of COVID was I talk a lot about Dow Chemical because it was so good to me. Not in terms of price. I mean, the price was as high as 70 and as low as 22 or whatever, 25 or 28 or whatever it got down low. I don't know where it is right now, probably around there. I bought it and it paid for itself in 4 years with the options I sold and with about less than 4.5 years. So I had all my money out of that by 2024, okay, somewhere around in there, roughly. And so it really changes your perspective. And I was on the earnings call, because if you own the company, you listen to earnings calls. And it was interesting because they're worried about tariffs. And the biggest problem they're having is just demand is down.
Yeah.
Globally, demand is down. When I bought them, their payout ratio was decent. Wasn't great, but it was like 70%. So they had some room. Now their payout ratio is atrocious. And they're stuck because, the first question they open it up to, like, you'll get Smith Barney or, Fidelity or whoever asking the questions on the call. And the first question they always ask is the dividend going to be preserved? And that's tough for them because they have not missed a dividend since they started paying it in 1912.
Wow.
So that's a hard...
113 years?
Yeah, I mean, that's older than I am.
Yeah.
So they've been paying that dividend consistently. They don't want... And Exxon will borrow money. They have in the past anyway.
Yeah.
They'll borrow money to pay their dividend because they've grown every quarter for 40 years in a row. So as I look at that, it's kind of interesting because I see them with this huge commitment to the dividend, which for me, that's all that matters right now. Stock's paid for, so price is irrelevant. Question I have now is how much cash flow can I get?
Yeah.
Like I would prefer never to sell it. So whether it's $20 or $70 or $100 or $200, who cares? I just want cash flow.
Yeah.
Once it's paid for, price is irrelevant. What is interesting is you can't run necessarily. Like I come back to maybe I'm oversimplifying it, but I come back to this cash flow Jack in the Box where, okay, this number, like who the hell cares? You never sell a stock because the price drops because it doesn't tell you anything.
Right.
Now this starts to tell you something.
Yeah.
If earnings
those
are
earnings
down.
change. Yep.
But okay, so price, that doesn't matter. Now, if the earnings start to drop, I have to ask myself why. Now, if this were Blockbuster Video, I would see a long-term trend of obsolescence to the work that they do. And if you see obsolescence where the work they do, that means the moat has dried up.
Yeah.
The people can storm that castle. There's no barrier there. But I look at this also cyclically because you can't run from one bad earnings report because no business ever just goes boom, 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 boom.
Yeah.
Every business has pullbacks and struggles and dragons slaying battles to fight. That's where you have to look at the work that they do.
Yeah.
And say, okay, do people still need silicone? Because they make a lot of that stuff.
Yeah.
Do people is there still going to need carpet and paint? They have some competitors. You got to see are they losing market share? Now that
Right.
speaks to the efficiency of work that they do.
Yep.
So you kind of have to dive into that handle. You start with the handle when you buy it, and you end with the handle when you sell it.
Yeah.
I really think that's true as an investor.
Yeah.
So as I look at them, I think, man, they're going to struggle to pay that dividend, man. They have really got to dig deep. But the other thing is they can scale. Like they can pause an operation and they can adjust to a lower demand. They can, they say, okay, let's pause operations in this plant. Let's reduce our workforce. Because your workforce can be plastic. As demand increases, I mean, we saw it at the Cash Flow Academy during COVID. My gosh, we had to bring on people because we had to expand with the demand of people saying, oh my gosh, I got to learn about this, right? So you can contract and expand your labor and your workforce. So it's been an interesting one with that company on their last earnings call to ponder, because I would not sell because of this, and I would not sell because of this. I would sell if I see the handle threatened.
The
Thoughts on
businesses.
that?
Yeah.
It's hard to make the Jack in the Box work if the handle breaks.
Yeah.
doesn't work at all, right? And if the handle is cranking like crazy, but no earnings pop out, something's wrong with that company. They're working inefficiently. So as you go into earnings season, I would summarize it with this. Number one, don't try to guess the earnings in order to profit from a price. That's backwards. Look in the rearview mirror in growth, like we talked about Amazon.
Yeah.
Look at what their trend is in the rearview mirror rather than forward to make those decisions. But if you want to see the future, look at the work they do.
Yeah.
And if you look at the work, then see the future of that. And when I see AI, I think everybody's work is going to get better.
Yeah.
I think you're nuts if you don't want a share of the world's production right now.
Yeah.
If you don't want to do what Warren Buffett said, the lowest way to participate in American business. What does that mean? It means stock ownership, I believe. Be a shareholder. So as earnings comes, don't lose your mind. Be thoughtful and smart. Look at the work.
I'll put on my, Nostradamus hat
Nostradamus?
here and make a little,
Yeah.
what I kind of envision for this, if I had my base expectation, here's my base case for how the markets are going to behave. I think we have moved into a bearish cycle.
Yeah.
So I think we saw, if you were an Elliott wave technician, we saw that first drop.
Big drop.
Right? And now we're kind of bouncing back.
We're in that Kiska buy area, by
Right.
the way. Would everyone agree technically we're at a Kiska buy?
We're in kind of that recovery.
Doji-ish.
The chart's kind of
shorter
making out right
candles.
now, basically.
What we mean by that, everyone, is we had this big 9% drop. We fought back to where the previous support is now we're getting smaller candles. Would you
Toward
agree?
the resistance,
Towards
yeah.
that resistance, yeah.
And that would
resistance.
be like the second wave back up.
Yeah.
Or even if this was a bull market, you'd kind of expect it to be an ABC.
I have not pulled my hedges.
Yeah.
I have left. I'm very delta neutral in my portfolio.
I have not pulled my hedges. Now that might cost me some if we break through that.
Well, it's opportunity
If we don't,
cost versus.
It's
Yeah.
insurance costs for me. If we break through and we don't kiss goodbye, technically, I'm going to lose some money.
Yeah.
But I feel the bearish.
Yeah.
I feel stronger towards the bearish side. I'm going to insure my car, my house, and my stocks right now.
And I hope I'm right from the standpoint of that would make the opportunity to buy at a discount even greater because another wave down. So my base expectation is part and due to I think there's phenomenal businesses. I don't think people are not going to stop using Amazon and stop using Apple and all these businesses. But did they get priced to an extreme where we need to now there tends to be a pendulum swing, right? So we kind of overdid it this way, that overreactive. And now we might overreact this way. But I think they're coming down for good reason. And part of that is if you look at AI, take the internet as an example, before you see the big benefit to earnings, there's always an investment first, isn't there? And so these companies are pouring tens of billions of dollars into investing in AI, which means in the shorter term, that's not going to look good for their earnings. It's going to build out business.
But the handle is getting better even if this is
if that's not. But the market will ahead of time say, well, if the earnings are going to take a little hit, we need to price that in. And I think the markets are already doing that. So I kind of envision the next year or so of a repricing for the fact that, look, every one of those big tech names have announced a $30 billion nuclear plant and all these different things that they're building out that is not going to generate them $1 of earnings. In fact, it's going to be a pure expense. So
in the short term,
shorter term, that is a hit to earnings. But if you fast forward 10 and 20 years, and now they have those nuclear plants and they're doing amazing things in AI and their efficiency is through the roof, then the earnings are exploding. And so generally speaking, that's kind of the cycle that I think we're in, is we're in the investment phase and the big benefits to that come down the road.
If I get solar, I'm not allowed to bypass the grid.
Yeah.
In other words, I have to connect my solar to that grid. I'm not allowed to generate my own power without say so.
Yeah.
How in the hell do you get your own power plant. If you nuclear, I can't put a solar panel on without sharing it.
Listen, when you're worth $3 trillion like Apple is, you get to make some of
that's the golden
rules.
rule. That's the golden rule.
Yeah.
He who has the gold makes the
when
rules.
your market cap is $3 trillion, like Microsoft, like
you
Apple,
build your own power plant.
You can do a lot of things.
You build your own nuclear power plant.
That me and you are not capable.
Some guys want a Ferrari, other guys want their own nuclear power plant. Right?
What, you don't have one? Come on.
You know what? I might be a human nuclear power plant.
No, you're not. You don't have any, you have no energy there.
No, I had chemo, radiation. I might be a walking nuclear power plant.
All three of us actually have had enough of that stuff. We can all glow in the dark, man.
Yeah.
My wife, Marcy, our producer, she glows in the dark. Okay. I could go really bad places that I'm not going to go. Marcy had breast. You know, it's funny. The humor in mine can get us canceled. I got to be careful.
Yeah.
I had testicular canceled, testicular cancer, and she had breast cancer. So the jokes between that anatomy,
where you glow in the dark, is
that
pretty
anatomy,
funny.
the jokes, the anatomical jokes that are, what's been removed and what is scarred. It goes downhill pretty fast in my house, and I'm in perpetually in the 9th grade.
Yeah.
So anyway, great stuff. Understand what earnings is. You can predict volatility crushes. You can't predict earnings and guidance very well. Well, you can predict it. It's hard to do. I think the biggest thing is educate. Always learning more every single year. Never stop. And awesome. Speaking of education, go to yourinvestingclass.com. Go there right now. It is free. There's a couple reasons I make that free. Number one, it's a great way to sample more of what we do at the Cashflow Academy. Costco, go, let's try this. Oh, that's pretty good. I think I'll get more of that. So we do it for that reason. But the other reason is I love the idea of no excuses. I think Jordan's the GOAT, not LeBron, but LeBron's not bad. And when he was on the Olympic team, Coach Krzyzewski had standards, not rules. And he let all the players collectively share the standards. And the one that LeBron put out there, he said, I'd like to nominate a standard of no excuses. And I love that, because when you have something for free, man, a person has no excuse because they got a chance to learn it. So go there now. Like literally go to yourinvestingclass.com. It's all one word, yourinvestingclass.com. And go there now, click on that, download that, read it, invest in yourself for free, and you just see if those 6 numbers won't change your life. You just see if the habits I talk about in that ebook wouldn't be a quantum leap towards your financial goals. So go to yourinvestingclass.com. I think Noah, I think Corey, this is my favorite part of the week, is when we get together and get to talk about the markets. And I learned so much from you guys. So thank you. You've been watching and listening to the Cashflow Academy podcast, where we make investing a lot of fun, very simple, and we always keep it real. We'll see you next time.